Think the PE ratio tells you whether a stock is cheap? It might be missing one of the absolute most important pieces of the valuation puzzle: free cash flow.
Relying solely on the PE ratio is honestly pretty dangerous. I mean, it's a useful first screen, sure, but it only compares a stock's price with its accounting earnings. If you're serious about fundamental analysis and finding truly undervalued U.S. stocks, you need to look at the actual cash. So today, we're breaking down free cash flow yield.
Section 1. What is FCF yield? A cash-based perspective. To value stocks effectively, we really need a cash-based perspective. FCF yield is exactly that. It's the missing metric that tests the real cash economics behind a business. The formula is super straightforward. It's just free cash flow divided by market capitalization. Basically, what this tells us is exactly how much actual cash remains after the company handles its day-to-day operating needs and pays for its capital expenditures. Things like maintaining factories, buying servers, or upgrading networks.
Let's break down the math using a really simple cash flow bridge. Step 1, you start with your operating cash flow. That's just the cash generated from regular, day-to-day business operations. Step 2, you subtract capital expenditures, or CapEx. These are the heavy investments required to maintain or even grow the business. And Step 3, you arrive at your free cash flow.
Let's put some real numbers to it to make it concrete. Imagine a company generates $15 billion in operating cash flow and spends $5 billion in CapEx. That leaves $10 billion in free cash flow, right? Now, if that company has a $200 billion market cap, you just divide that $10 billion by $200 billion, giving you a 5% FCF yield. In plain English, this simply means the business generated about $5 of trailing free cash flow for every $100 of equity market value.
Section 2. FCF yield versus PE. Head-to-head metrics. On one side of the ring, we have the classic PE ratio, which tells you the price paid for $1 of reported earnings per share. On the other side, we have FCF yield, which shows the actual cash produced relative to the equity market value. The absolutely crucial distinction here is that PE describes the price of accounting earnings, while FCF yield tests the actual, tangible cash economics sitting behind those earnings.
So why is FCF so incredibly important? Well, because it reveals exactly what PE misses. The PE ratio completely ignores capital expenditures, cash conversion timing, reinvestment requirements, dividends, stock buybacks, and debt reduction. Think about it. A company can report incredibly strong earnings per share while simultaneously burning through a mountain of cash to build massive data centers, factories, or retail stores. When there's a gap between reported earnings and actual cash flow, FCF yield brings it right into the light.
Section 3. Real U.S. stock examples. Latest market data.
Let's actually apply this theory to the market and see how these metrics diverge in practice. Look at Apple. They generated a massive $129.17 billion in trailing 12-month free cash flow. But because its market cap is so exceptionally high, that only translates to a modest 2.61% yield. Microsoft sits at a similarly low yield, which typically happens when investors expect continued growth and a sign of premium valuation. Now contrast that with PepsiCo. They reported a 4.86% FCF yield alongside an 18.29 PE ratio, proving that the earnings story and the cash valuation story can look very different depending on the specific business model.
And then we have Amazon. Notice that negative $2.47 billion trailing free cash flow? Despite strong earnings growth, Amazon's FCF was actually negative because its capital expenditures were exceptionally high relative to its operating cash flow. This heavy CapEx really matters. And remember, negative free cash flow is completely invisible if you're only relying on a simple P/E screen.
Section 4. The beginner's workflow. Step-by-step analysis.
Real quick, if you're finding this explainer useful, make sure to subscribe, share this explainer, and like Fox of Wall Street. We cover practical stock valuation and fundamental analysis to help investors make better informed decisions. Okay, so here is a strict 6-step beginner's workflow for analyzing FCF yield. First, understand the industry. You want to compare businesses with similar capital intensity. Second, use trailing 12-month data plus several years of history. Definitely avoid drawing conclusions from just one quarter. Third, inspect those capital expenditures carefully, separating basic maintenance needs from aggressive growth investments. Fourth, check FCF conversion by comparing it to net income over time. Fifth, always check debt and share dilution. And finally, compare the yield with growth. A lower yield can actually be perfectly reasonable if the business can compound cash rapidly at high returns.
Section 5. Common valuation mistakes. Valuation traps to avoid.
Value investing is incredibly powerful, but there are definitely traps that can destroy your portfolio if you aren't careful. A high FCF yield absolutely does not automatically mean buy. Buying the highest yield blindly is super dangerous. It can sometimes signal deteriorating fundamentals or a peak cycle cash flow, rather than a truly undervalued stock. Other massive mistakes include ignoring negative FCF without understanding exactly why it's negative, comparing totally unrelated industries with different capital needs, using just one single quarter of data which can be wildly skewed by working capital swings, and ignoring debt and dilution, where cash might rise while your actual per-share value just stagnates.
Section 6. Complete Valuation Framework. Combining PE and FCF.
The absolute strongest approach to investing, for beginners and pros alike, is not pitting PE against FCF yield, but rather combining them. Let's break down this decision tree. If you see a low PE and a high FCF yield, that's potentially very attractive, but you must investigate if that cash flow is actually durable. What if you see a low PE combined with a low or negative FCF yield? Well, that might indicate a dangerous value trap, where earnings simply aren't converting to cash. And a high PE with high FCF growth, that premium valuation might be totally justified, provided you investigate exactly how much of that growth is already priced into the stock.
Ultimately, this is the complete framework you should be using. P/E plus FCF yield plus FCF growth plus return on invested capital plus balance sheet strength plus capital allocation. Just keep in mind, a low FCF yield can be completely justified if the company has a credible, proven path to compound cash rapidly at high returns on their reinvestment.
I want to leave you with one memorable investing question to ask yourself every single time you look at a stock. How much durable free cash flow is this business generating relative to the price I'm paying? Free cash flow yield is an incredibly powerful starting point for your stock analysis, not a standalone buy signal. It forces you to ask cash-focused questions and look past accounting earnings to see the true economic engine of a business.